All right, good afternoon, everyone. BD from Bluestone Flagship Investor. This month's guest is actually Mark Gross, and Mark is a specialist when it comes to cost segregation, and that's probably something we're going to cover in today's call. So, no further ado, Mark, why don't you just give everybody a little background about yourself and the company and what you do?
Sure. Thank you very much. I appreciate this opportunity. Um, a- as BD indicated, I'm Mark Gross. I'm with CSSI, which is Cost Segregation Services. We're recently going through a rebranding whereby we're adding a lot of other services in addition to cost segregation. So now we're going to be CSSI services. So just want to let you know in case you look at the email, you'll see there's some transition going on there. So I've been with them, I think around 14 years now. It's been a while. And what I do is the cost segregation, and we'll get into details as far as what that is. My background prior to that, I was in management, upper management for different companies. One was a manufacturing plant over 1 million square feet. I oversaw all the supply chain activities for an office furniture manufacturer. I also oversaw a retail chain, so I've had a lot of background in business and finance and looking at numbers.
Great. So I'm gonna share the presentation, and if you wanna take us through that.
Sure, we could go on to the next slide. And one of the questions that I frequently ask, because I do a lot of in-person presentations, and I'll ask people and I'll try to get feedback from the group, and that is, why do investors own real estate? And BD, you want to take a swing at that?
Yeah, no, for many reasons. They like the appreciation, they like the cash flow, and the best part is they like the depreciation, which is the paper loss that helps them basically save a lot of money.
Mm-hmm. Yep, you're right. There's a lot of different variables and a lot of different directions you can go in that regard, because a lot of different property types will have different avenues to achieve those different goals. So we can go on to the next one, and that is, and you kind of alluded to it there. Why is it advantageous to quote unquote lose money in real estate? The whole objective is to gain money, right? Why would you want to lose money? Well, that's I'll show you how you can have a paper loss and how that can be advantageous for you when you do commercial real estate. So let's move on to the next one. And this is a little dated. We can tell this is during the COVID time. We had the mask over Ben Franklin there. And what are we going to be talking today about is not just the cost segregation, but also bonus depreciation strategies and basically, how we can unlock this cash flow for people who own real estate. So let's go on to the next page. And some of the topics we're going to be covering is just in general, what is cost segregation? What is bonus depreciation? What qualifies? What are some of the bonus depreciation changes? What are good candidates? And PADs, partial asset disposition. And let's kind of start off with what cost segregation is, and we'll show you some other graphs and things like that, which will depict what that is. But basically, what we do is identify what are the components within a property that could be depreciated faster. So when someone buys a property, what a CPA will do is take a look at the acquisition cost, subtract the land, because you can't depreciate the land, and take the balance of that and depreciate it over 27 and a half years for residential properties and 39 years for other property types. So let's say they buy something for 1.2 million, the land is 200,000. The CPA would take that $1 million and extend it over all those years. I was at a trade show a couple of days ago, and one of the things I talked to one of the guys about, I pointed down at the carpet. I said, is this carpet going to last 39 years? He says, no, it's not going to last 39 years. So what we do is we will identify those parts. For instance, a carpeting is considered to be 5-year property. So even without bonus depreciation, and I'll get into bonus, but even before there was bonus depreciation, you could still depreciate things on a shorter time period. So for instance, your parking lot's considered to be 15-year property. your carpeting and a lot of other molding, things of that nature, 5-year property. But then there's something called bonus depreciation. And what that does is allows you to take the lion's share of the depreciation and actually depreciate it in the first year. And we'll get into some of the details of what that is in a little bit. But just to give you a little bit of a history on this, bonus depreciation for new acquisitions came about at the end of 2017 as part of the Tax Cuts and Jobs Act. And what it did was it indicated that if you have anything which has a life, and this life is determined by the IRS, of less than 20 years, you can depreciate it the first year of acquisition. And that was huge. We've been doing cost segregation for a number of years, but that kind of put it on steroids, and we're able to take a lot more losses in addition to just the regular ones. And what properties are good candidates? Really anything. I mean, obviously, some properties are going to have more components than others, so therefore you're going to have more depreciation than others. Believe it or not, one of the property types which has some of the highest amount of cost segregation are mobile home parks because of all the infrastructure that's within there. It's amazing what you can have. And some of the ones where you might have a lesser percentage would be maybe like an industrial property, where typically you have 80% distribution, manufacturing, warehouse, things of that nature, and the other 20% is office. So within the square footage of the office area, you would have a lot more componentry to depreciate than you would in more of the plain vanilla type manufacturing industrial type of setting. And there's also something called PADS, or partial asset disposition, and that has to do with after you've acquired something, you might be doing some sort of renovation, CapEx expenditures, and we'll do a separate study in regards to that as well. So let's go on to the next page. And what I'm going to be talking to you about, some people ask, was this a loophole? Is there, are you going to get into trouble for doing this? And you can be assured that everything that we do is based on the IRS guidelines. And just to give you an example of the tens of thousands of studies we completed over the years, we haven't had a study overturned. And what's the reason for that? Is because we do it all by IRS guidelines. And when you do it all by IRS guidelines, you're not going to have a problem. Now, we've never had a study that's triggered an audit. We've had some clients that have been audited for some other reasons, and therefore we've had to go in and defend it, and we have successfully done that. So it's not a loophole. You can be assured of that. So let's move on. So I alluded to this earlier as far as what are some of the what is cost segregation, and what it's basically doing is segmenting out what are the parts of the property that can be depreciated. For instance, let's take an office building or multifamily, something where you have a building structure, maybe you have brick on the exterior or something like that. There's going to be certain of the main components or structural elements within that property that you will not be able to depreciate. That's going to have to be part of the 27.5 for residential, or 39 years for the other property types. So that's what these studies do. And as a result, what it does is it lowers income tax and creates more cash flow. Well, how does that work? Well, let's say, for instance, let's keep it simple. Let's say that you have $100,000 in income. And of that $100,000, you have to pay tax on that based on whatever your tax rate is. Well, what if our study were to create an additional $100,000 of depreciation? So if you take a look at your profit and loss statement, you would have your income of $100,000. You would have a line item which would be depreciation, again, a non-cash expense, but still it is an expense which would then go against your income, and then therefore it would reduce your income to zero, and you would pay zero federal taxes. So that's basically how it works and how you get cash flow. And then we talked about the 27.5, 39 years. You can see the difference there. And how much can you really benefit from this? Well, there's going to be a variable depending on the property type. And I kind of alluded to that earlier, talking about some of the property types like a mobile home park and manufacturing and office and medical, where you can have a higher amount of componentry within that property that you can depreciate, as opposed to, let's say, like like an industrial property, like I mentioned previously. So that's why we had to give a range of $30,000 to $80,000 per $1,000,000 for first year for bonus depreciation. And the main effect is that as far as what are size properties that you do this with, typically I say $350,000, maybe a little bit less, excluding the land value, because you can't depreciate the land, so you have to keep that in mind. And then also can take into consider what type of capex expenditures you'll be doing as well. But the typical return on investment is at least 20 to 30 times, or frequently much higher than that. One thing I will mention about bonus depreciation is that it was 100% when it came about at the Tax Cuts and Jobs Act in 2017, but it had a sunset clause in it. And then what happened was the last year it went to 80%. And then 2024, it went to 60%, and it's going to go to 40%, then 20%, and then it's going to go away. However, there is a bill in Washington, D.C. right now to try to resurrect that to 100%. And we were kind of optimistic about that the end of last year and the first part of this year, thinking that it might go on, might get passed, but at this point in time, it still hasn't. So stay tuned. Can't really tell you what's going to happen on that. So let's go on to the next page. And probably need to redo the pricing on this a little bit. You can't really get a Big Mac for $3.99. But BD, do you remember the old McDonald's commercial? 2 all beef patty special sauce.
Absolutely, yeah.
Yeah, now some
That's a good
youngsters
one.
may not remember that, but this was a real popular advertisement campaign that McDonald's had. And what they did was they said, well, you've got your Big Mac, but then there's a lot of parts within the Big Mac. And kind of think about this as an analogy as far as the Big Mac or the hamburger being a building. So what do you have within that building? You've got different components. You have your carpeting, you have your parking lots, you have your moldings and your electrical and plumbing and HVAC and all those other things. So that's what our study does. We'll go in there and identify what are all the pieces and parts within that property. So that's the analogy we use for that one. Let's move on here. And one thing we mentioned before, and see that bucket at the top there. You remember, BD, what's the difference between the 39 and the 27.5?
Yeah, so for residential, I believe it's usually depreciated over 27.5 years. And
Right.
for commercial properties, it's depreciated over 39 years.
Right. So that's what that bucket is for there. And what you can see is that there's different parts of the components within the property, which would be 5 or 7 year property or 15-year, and that's what our study identifies. So let's move on to the next
So
one.
effectively, if I can just build on that, Mark, what you're saying is you just typically, take your stuff to your CPA. They're likely to say, okay, this is a residential building, and I'm going to do a straightforward depreciation over 27.5 years, and every year take a chunk, right? That's a straight line depreciation. Instead, you can really benefit from this depreciation, especially in the earlier years. And that's when you come in and you run cost segregation and you break down those depreciation into different buckets. And this way, using these buckets, you can start to accelerate the depreciation that you have in the various different buckets at different times. That's kind of like the big picture.
That's a great synopsis. Yeah, thank you. The next page kind of gets into some of the detail as far as what's within some of those buckets. I'm not going to read all of them, but you kind of see what the different components are that will fit within those various buckets. I did allude to earlier as far as how there's still going to be certain parts of the property that you're not going to be able to appreciate. And here it gets to know some of the details as far as the structural and foundation and walls and and things of that nature. So let's go on to the next page. And this will give you a detail as far as some of the items within the 5 and 7 year. that would qualify for bonus depreciation.
Yeah, so in a big picture perspective, the biggest value that you get in the bonus depreciation is really taking those items for the 5 and 7 years, right? And doing all of them in the first year, or whatever the allowance is. Right now, it's a 60-40 allowance. It used to be 100%, then went up to 80-20 and so forth, correct?
Right. But then because bonus depreciation is anything which has a less than 20-year life, your parking lot is considered to be 15-year property. So that would even fall under the bonus depreciation, as well as being able to take the lion's share of that the first year as well. So anything less than
Great point.
20 year.
That's a
So
great point.
let's move on. This kind of gives you a graph as far as what the difference is here. If you take a look at the blue line, that would show you what we've been talking about as far as what's the straight line depreciation. And then your accelerated depreciation without bonus, that's where you can take a lot of the depreciation on items which are in the 5 and 7 year buckets, and also the ones that are in the 15-year. But then with the green line with bonus depreciation, you see the huge hockey stick spike there in the beginning. That's where you front end load a lot of your depreciation costs into the first year.
That's great. So it's effectively not really creating more depreciation, just being able to use them a lot sooner in some sense.
Correct. And let's move on to the next one. What are the different property types? And I've done virtually all these different ones, and I've seen a lot of them. I'll give you an example of one project that I did here recently for a client. He had some strip malls in the area, and I was able to save him over $2.5 million on his taxes this year. He had a huge equity event, and he was going to be hit very hard with taxes. And these studies that we did for his properties helped them to eliminate that. He said, I'm going to go out and buy another $20 million worth of properties this year. So that's an example of real life example. But they don't all have to be these big properties. I work with one client here locally where I'm at in the Chicago area, who contacts me every year. And he's got a regular job, but what he does is he's an investor on the side. And every year he'll go out and he'll buy multiple duplexes or single family homes or things of that nature. And he'll go ahead and get a cost segregation study on those. And some of those might be only in the $300,000-400,000 range. So you're not going to be saving millions of dollars, but maybe you spend $3,000 or $4,000 and you save 50,000. But still a good return on investment for you. So the way our process works is that if someone wants to know what's the estimate of how much I'm going to save, we have a simple PDF that they fill out, which asks questions about the property. What's the square footage? How many parking spaces do you have? If it's multifamily, how many units do they have? Are they all the same, configuration as far as, 2-bedroom, 1 bath, and things of that nature? And with that information, we're able to, within 2 business days, come back with a free preliminary analysis of what the estimated savings are going to be, and then also the cost of the study. And the estimate that we provide is always conservative. Over 90% of the time, the actual results are higher than our estimate. We prefer to underpromise and over deliver on that. So it really works on any property type. And we'd like to be able to make sure that our clients are well informed as far as what the anticipated savings are going to be for them. And the other questions we kind of flush out is this part of a 1031 exchange? We do 1031 exchanges all the time, but there's extra hoop we have to jump through. We have to take a look at what's the cost basis of the property that they sold. We have to look at the depreciation schedule on that one. And there's other variables in that regard. Another point, and I think we might be getting to it later here, but I'll interject it now that I'm thinking about it, and that is maybe there's some instances where it may not make sense to do a cost segregation study. In a case like that, one of the pre-qualifying questions that we ask is, what's your hold period going to be? Are you going to be holding that property for 5 years or 3 to 5 years? There's something called a recapture tax. And what you want to be cognizant of that is when you get these benefits, if you go ahead and you flip that property, then you're going to have to pay back that money. And what's advantageous with holding something for at least 3 to 5 years or longer, that I'm working with very savvy investors. They're not taking that money, putting in the bank account and getting 1 or 2% or sticking in another mattress. They're getting double-digit returns. They're getting a good return on their investment. So you want to make sure that whatever savings you have, you're going to be reinvesting, and you're going to be able to hold your property for a long enough period of time, so you're not going to be affected by that recapture tax.
Yeah, so maybe I want to just maybe touch on and ask you questions here, Mark, if you don't mind. So it seems like different type of property might yield different levels of, cost segment amount of depreciation as far as bonus depreciation. I know a lot of investors in our group not only invest in commercial property, but for example, they have residential rental properties. Now, is the treatment on the depreciation, whether it's a long-term rental or a short-term rental, the same thing, or there's some nuances when it comes to cost segregation?
Well, that's a great question. What's interesting is some people, in fact, even some CPAs that I know are not familiar with the distinction between those two. They think it all is being residential. But if you have a short-term rental or Airbnb type property, that's actually classified in the category of a hotel. So it's not considered to be a residential property. That's going to have to be a straight line depreciated over 39 years. Because if you have short-term, leases or, rentals on a property, as opposed to a 12-month lease on a multifamily, it's going to have a different classification.
Right. So there might be some even benefit if somebody, have a residential property that they're running it as an STR, not to use a straight line depreciation, but actually run cost segregation to benefit from that accelerated depreciation from an Airbnb
Yeah.
instead of using a 39-year schedule, 30.5-year schedule.
Yeah, and again, the devil's in the detail. I'll give you an example of, I did some Airbnb properties that were in Kauai, Hawaii, and they were actually condos. And what was interesting there, you remember me saying earlier that to determine the building cost that you can depreciate is based on the purchase price minus the land. Well, in this particular case, based on the condo association, they did not own any of the land. So when you have a situation like that, you're actually able to take the entire acquisition cost and use that as to be able to determine what your depreciation is going to be. In a similar regard, like I had a Walgreens here recently in Florida where it was a land lease. So he actually had a triple net lease with Walgreens on this property. He did not own the land. He owned the building. So again, that was a scenario whereby we're able to take the purchase price and be able to use that entire amount instead of depreciating the land like you typically do. Now that's an exception rather than the norm, but those are the type of questions that we ask. We want to flush out because we want to be able to save our clients the maximum amount. So, any more questions on that before we move forward?
Yeah, actually, there's one interesting one as far as restaurant. Does that include also equipment as well, or you just focus more on the cost segregation for the building itself? For example, when you're talking about restaurants or QSRs
It's going to be for the building itself,
for the
but
building.
it, yeah, because and then I actually because I do a lot of strip malls. You might have ones like a Dunkin' Donuts or Chipotle or something like that. I run into a lot of those where they have eating establishments within a retail strip mall. But even in that regard, I mean, there's a whole lot that can be depreciated there. So those are wonderful. So if we go on to the next one, we talked about how you get that first year cash flow, accelerating your tax write-offs. Again, this is all compliant with the IRS tax code. And I'll give you a little caveat right now. I've had some clients that will contact me and say, I like to do a cost segregation study, but I don't want you guys to come out to the property. I don't want to have a person there that's going to do a site visit and all that. And I'll politely just tell them, I'm sorry, but that's not what we do. Uh, you need to go somewhere else. And what's the reason for that? Well, one of the things I indicated earlier is the fact that we will defend at unlimited expense the study in the event you ever get audited. We know that being able to have a physical person on that site, take hundreds of photographs, have all the documentation, that we're going to be able to successfully defend that. We want to sleep well at night. We want you to sleep well at night, knowing that if there's ever going to be any problem, or I should say, with an audit with the IRS, there's not going to be any problem because we have all the documentation. It's all going to be done correctly. You're not going to have a problem. If you're looking at ways to maybe, I had some people say, well, my CPA is going to do it. I said, well, is your CPA going to go out there and do a site visit? They're going to have all this documentation that's required. And they're like, well, I don't know. Or I just say, well, obviously I can't tell people what they're going to, what they have to do. But I just tell them, we want you to be able to sleep well at night knowing there's not going to be any issues, and that we only do the gold standard of cost segregation. And I'll tell you another benefit for this, and there's a classification that you may be aware of, and that's called a real estate professional. And that is, do you work at least 750 hours a year in the real estate industry? There's a whole lot of details. Or do you materially participate in running your properties, things of that nature? Or, and this is the very interesting one, do you have a spouse who's a real estate professional? Because if you have a spouse who's a real estate professional, any excess that you have on your depreciation, you can actually go and you can put that against your W-2 income, which not everybody is aware of, and that's huge, and that's one of the benefits. What I would suggest, because every situation is different, and I don't want you just to take this information I'm telling you now and just run with it. Talk to your tax counsel to find out exactly what you or your spouse's status is. Any questions
Yeah,
on that one?
yeah, no, that's definitely a great point. So what you're saying is when somebody qualifies as a real estate professional, they would have to work with their CPA to do that. Now the cost segregation start to actually impact their taxes in a significant way, right? It starts to kind of offset active income, not just property related incomes and so forth.
Yes.
So that's definitely probably another example while we're on the, I mean, I know we're not tax specialists or giving anybody tax advice here, kind of
Right.
discussing more educational information. Um, do you feel that as a lot of people, instead of doing 1031 exchanges when they were getting 100% accelerated depreciation year one, it kind of muted doing 1031 exchanges? Like if you're selling a property and you have a 250K gain, and you buy another property next and you run cost segregation on the newer one, and now you can get loss to kind of offset that gain. Do you see that as a common thing, or where would be some cases where you see it more applicable and where the cases there are less?
Unfortunately, the answer is it depends, because each situation is going to be different. I've quite frankly have seen some scenarios with a 1031 exchange where it really had a negative impact on whether or not it made sense to do the cost segregation, which is why we ask for all that information up front. Sometimes that might have a bearing on, how much did you pay for it, how much did investment or improvements did you put into it, how much did you sell it for? And that's why when we do the analysis, our initial analysis, is we will ask them, is this part of a 1031 exchange, and what are the details in that regard? Because we want to make sure you're cognizant of all those details, and whether or not it makes sense for you to do it or not. Because in some situations, it may not make sense. And our objective is not to sell someone a study if it's not going to be meaningfully beneficial for them. And another thing I'll mention here too is sometimes people will say, well, the estimate here is really more than what I can use this current tax year. Am I going to lose that? And the answer is no. any amount that you have as far as the deduction, which is greater than what you can use in the current tax year, you can use that indefinitely until it gets used up. So that's one thing to keep in mind. Another thing too, and I just had this recently with a client whereby they bought something last year, and typically the ones I'm getting right now, they're for clients which are on tax extension for 2023. And so I asked him the question. I said, "Is this for this current tax year or next year?" He says, "Oh, it's for next year." Well, that's fine, but for one thing, it's going to reduce the amount of savings a little bit because some of the first year is going to be straight line depreciated. But there's another thing too, it's called a Form 3115, the 3115. And that's going to be required whenever you have a property which is straight line depreciated, and then you switch to cost segregation. It's a very extensive form which needs to be filled out, but you don't need to amend the previous year taxes. And what it basically does is it tells the IRS, I used to do straight line depreciation, but now I do cost segregation or accelerated depreciation. And you do not increase the chance for audit or anything like that. It's pretty routine. And if you have any questions on that, we can go over it. But another thing I'll mention too, I alluded to the recapture tax. A lot of my clients, their objective is to build generational wealth, and they're looking at not just for themselves, but for their children, for their grandchildren. And when you talk about the recapture tax, there's something where a lot of my clients are cognizant of the fact that if they pass away, then there's no step up in basis. So basically that recapture goes away. So that's not something, that they need to be concerned with. That may not be the scenario for everybody, but quite frankly, for a lot of my clients, that's what they're looking to do.
So effectively continue to acquire at lower cost basis, pass that on, and then at some point pass it on to their children through the living trust, where there's going to be a reset in cost basis, right? And don't have to deal much with the recapture.
Exactly.
Right. Yeah.
So
Do
if we
you
go
see?
on here, I can give you here a couple scenarios like
Yeah.
self-storage, apartment building, dental, and you can see these are real live examples of savings that we've had for some of our clients in different property types over the years. And moving forward, I love this one. We talk that looks like a pretty ugly building, doesn't it? But
It does. Those are
in,
my
in,
favorite. I see money potential. Some people
yeah.
see ugly building. I see money potential, but
There you go. Well, in this particular one, what was interesting, you can't really see it from the photograph, is that they had a huge parking area. And, I mentioned earlier that the parking area is considered to be 15-year property. And if you have bonus depreciation on that, that's less than 20 years, so you can depreciate the first year. And you can see on this particular one, the purchase cost basis was about 1.8 million, but what was eligible for depreciation was almost $900,000. So that's huge from a percentage standpoint, and it's quite frankly it's unusual, but it does happen.
so in a case where they acquired this $1.8 million property on the loan, right? Where they put, I don't know, one third of the money, $500,000-600,000 of a down payment, and they took a loan on the rest. So they're almost getting 800,000 depreciation on a $600,000 of equity. So almost 100 and something percent when you look at the investment to depreciation ratio.
True, but you do need to consider that there was probably some land value there too. So
That's
the
true.
1.8
That's true.
would be the purchase excluding the land. But you're right, yeah, pretty high.
Right. So if you exclude the land and then kind of look at it from a percentage standpoint, almost you can get 100% depreciation in the case like this. That's
Yeah,
incredible.
yeah, it really
You
was.
know, so if you say you made money on a previous sale of a property and you roll the money into this project, it doesn't even have to be with a 1031. It seems like just taking accelerated depreciation, you can wash away the tax liability of the capital gain you could have had on a previous deal or a completely separate deal that you actually had.
Yeah, that's why people do it.
Yeah. So some people refer to it as the lazy 1031, without all the paperwork, in
And,
some sense.
and I've talked to a lot of people that do 1031s, and a lot of them work out really well. But if you know much about 1031 exchanges, you have time parameters on that. You need to identify what are the properties you want to do for 1031, and you only have a certain period of time, 6 months, to be able to close on that other one. And quite frankly, I've seen some people that, because of the time constraints, they buy something, maybe they pay too much for it, or maybe it's a less than desirable property. So there, sometimes you may get pressured into utilizing the 1031 and maybe buying something which is less ideal.
Yeah, and I'll tell you, last acquisition of last year, 2023, we we invested into a Dallas multifamily property, and we just received the K1s on that and almost got 93% of our invested capital as far as K1 depreciation. So it's definitely a great if you could use that and use it to offset other gains that you have in your portfolio. So that's
Exactly.
really what I'm a huge fan of this strategy, where I actually feel that it actually works.
Yep. Very good. Now, one thing here, we talked about U.S. taxpayers, because obviously we're talking about IRS taxes. I will interject something here, and this is really outside the norm. And it can work for a U.S. taxpayer who's buying some properties overseas. I had a CPA contact me recently, and he said he has a U.S.-based taxpayer who bought some property in Paris, France. And what would the cost segregation study do for him? And what we did was we ran the analysis, and there are different tax rules that exclude bonus depreciation and other things. I won't get into weeds on all the details, but which really make it more challenging to make it cost effective. In this particular case, it was kind of questionable whether or not it was going to be worthwhile. It wasn't the type of ROI that we typically have, but there could be some situations where that might be beneficial. And as far as the cost basis, I typically say $250,000 or greater, excluding the land building. So that's what the building cost basis means. That means the cost excluding the land. And the other thing too is that it may be advantageous for people who are leasing a property. But actually, I was at a conference. There was a retail show that the last couple of days, and I was talking to one client. They're talking about, well, what if I go ahead and I've had a whole lot of improvements that were made. And I said, well, what about the TI? The TI is the tenant improvements. I said, typically that's being paid by the landlord, and they do some sort of or rent payback or something like that. And he said, yeah, that was a situation being done by the landlord. So in that situation, the person who's leasing cannot take advantage of it if it's not coming out of their pocket, if they're not paying for it. But there's some situations where maybe, it is opening up their own pocketbook and putting in the improvements, then they can take advantage of the CapEx improvements. And I alluded to this earlier also, not advantageous for flippers. If you own something for less than 3 to 5 years, it's probably not going to be worthwhile doing because of the recapture tax we're talking about.
Yeah. So the 250K is kind of interesting. In the case of somebody building an ADU on their property, spending 250 to 300K, there's probably no land cost, right? When you're running the cost segregation, it's really the cost to build the ADU and maybe improve the land. Um, what would be some of the thresholds in your mind that you think would be applicable for, or first of all, can an ADU also qualify for a cost segregation? And in your mind, like, do you really see where there's certain thresholds where it starts to make sense?
Yeah. Well, we're gonna run the numbers on the example that you just provided for us, but I would say that in most instances it's going to be advantageous. I hesitate to give you any numbers because they could be all over the map, because unfortunately each property is going to be different than another one. And that's why I prefer to have some specifics about the ADU or the property, so we can give you some pretty hard numbers as opposed to it's going to be this, that, or the other. So,
Sure. No, absolutely.
so here's an opportunity for you, or if maybe you have some clients or other people that you know, relatives, friends who can be able to take advantage of it. How's our process works? Well, we have a questionnaire you fill out, free preliminary analysis, and based on that, we are able to give you a very conservative estimate of what your savings are going to be, and then also what your cost is going to be. The cost is not a percentage of what the savings are. Maybe you go to an attorney and do an appeal on your property taxes. And the attorney said, well, okay, I'll go ahead and do that, but I'm going to take 50% of the savings. With it, we don't do anything like that with a cost segregation. It's going to be a flat fee, but the flat fee, of course, is going to be variable depending upon the property. You have some which will be on the low end, and like the one example I told you earlier, where the client paid $60,000, but he got $2.5 million in savings. I mean that's a huge ROI. So it's all relative, but we run the free analysis for you guys. And just briefly, we'll get into the partial asset disposition. We also are able to identify, because I have a lot of clients that maybe are buying a Class C multifamily apartment building, and they're going to turn it into a Class B, and there's a fair amount of renovations that they're going to be doing. And we will do analysis not just on the acquisition, but also on the capital expenditures that they're doing also. And in addition to the cost segregation, we're also providing R&D or research and development tax credits. Not enough time to get into all that today. There's also something called the Section 179 energy tax credits with the building envelope and with the LED lights and things of that nature. We also have something called the green zip tape that happens to be this tape that I have here, what in a situation like that, we're able to take non-load bearing walls within a property, and let's say a $10 million property will save about $500,000 to $1 million. Because what it does is it actually makes those interior non-load bearing walls depreciable because of the installation process. Rather than nail in the drywall, you screw it in, you put in this patented tape. You can take it off. The drywall is reusable. It's more environmentally friendly. It's ease of access. Let's say you have an electrical or plumbing issue behind the wall. You can just take the panel off, repair it, put it right back up there. And also 17 extra LEED credits. That's the environmental credits as well. So that's another thing. I'm doing a ground up in the Houston MSA area with that tape right now, another one in Columbus and some others around the country. So that's that. So who are we? We're the largest in the industry, having done these studies for over 20 years. We've done over 50,000 studies. What's the timeline? Once you commit to it, it takes about 4 to 6 weeks. Actually, in the summertime right now, we're looking more around the 2-3 week period of time before things ramp up with the tax extension period. And that's pretty much how it works. And one thing I'll mention is that with the fee, 50% of the fee is due up front, and then the other 50% is when the study is completed. So any questions?
No, that's great. Actually, thank you, Mark. There's probably a few questions have been submitted, so I'll stop the PowerPoint unless there's okay. I'll leave this in the background in case somebody would like to reach out, so it'd be recorded in the video. So a few questions maybe I can take that have been kind of pre-submitted. One was, can you actually, or to summarize, you said if you're really planning to keep the property 3 to 5 years, then it makes sense to start looking into a cost segregation. Is that correct?
Now, because of the recapture tax, you're always going to have that recapture tax, but if the longer you hold your property, the amount of money that you save, let's say you have $100,000 you save the first year, you're going to get, most of my clients are getting good double-digit returns on that money, and you want to make sure that the returns you get on the savings is going to far outweigh whatever your recapture tax is going to be. So that's why we recommend, 3 to 5 year. I mean, I actually had a client who said, I'm looking to sell this in 2 years. I know all about the recapture tax, but I don't care. I'm going to do it anyway because I know the huge ROI I'm going to get on the savings. That's an exception. We prefer to be conservative and say at least a 3 to 5 year hold.
And what is usually the typical process for, somebody engaging with you or your company? You mentioned something about running an estimate. Do you mind maybe sharing a little more what that process would look like?
Sure. We have a one-page questionnaire that will ask information about the property. What's the address? What's the property type? What's the square footage? What's the configuration of the apartment units? Things of that nature. Maybe you have an apartment complex. What additional things do you have? Do you have a play area? Do you have a in-ground pool? Separate laundry facility? Things of that nature. We also will ask what's your estimated tax rate. Sometimes syndicators don't know that exactly, and we'll say, well, let's be conservative. Let's put something out there what we think might be the average for the tax rate, because the savings is going to be a result of the depreciation and the tax rate associated with that. Also, the question that I mentioned earlier about the 1031 exchange, is that part of it? It doesn't indicate you don't do it, but we just need to get that information to be able to see whether it makes sense. And then also, what's the hold period going to be? And with that information, our analysts will take a couple of days to review it, and they'll take a look at similar type properties that we've done and be able to come up with the conservative estimate of what the depreciation and the tax savings are going to be, and then also what that flat fee is going to be. So then the client has all the information, they can make an informed decision on whether or not that's something they want to move forward with. Once they do move forward with it, 50% of the fee is due up front. And then what we'll do is we'll schedule the site visit for someone to go out to the property to take hundreds of photographs, gather all sorts of information. If blueprints are available, if there's OM, the offering memorandum, that there surveys, all appraisals, all sorts of information about the property. And then our engineers will review all that data, and then the study will be completed in the typically the 4 to 6 week time period. It does change a little bit when we're in very busy tax time. And another thing I'll mention here too is that when the study gets delivered, for the most part, I get it. I'll send it to the client and their CPA, and I never hear back from them as far as any questions are concerned. However, there's some CPAs that are not as well versed with cost segregation or understand, what I do with this information. And we will schedule a call and go over it with them. We don't charge anything extra for that. That's just part of our service, because we want to not only help the client, but also their tax professional to be able to help them be able to utilize the information in the study for their clients' tax returns. And that's pretty much it. The only deviation from that is that when someone buys something and they're doing major capital expenditures on it, I'm just talking with a client about this week. They're buying it now. They're going to be doing a lot of capital expenditures this year, but then they're also going to be doing it into next year as well. So what happens is we do the study on the initial acquisition, and then at the end of the year, end of December, we'll take a look at what are all the capital expenditures that you did. What's the details of that? We'll do a separate analysis or study on that part of it. And then whenever they're completed with the renovations the following year, we'll do a separate analysis on that as well. So in this particular case, they would actually get 3 reports. They would get one, which would be on the initial acquisition. the renovations they did for the current tax year, and then also for the following tax year, or however many years it takes for them to complete it. Typically, it's done in the first or second year.
Yeah, so that's actually another scenario that makes sense where they immediately get to depreciate the acquisition, then they put in the CapEx dollars and get the benefit of depreciating the CapEx dollars at the
Hmm.
same time. Wow. And then
Yeah,
that report gets sent to the CPA, and the CPA is the one that issues the K1s, correct, that
right.
the investors could actually
Hmm.
use. Eh, and typically in terms of the the 100%, 80/20, that's all done at the CPA level, correct? The CPA is the one that determines. Um,
Yeah, based on whatever the current tax rules are. For instance, if our friends out in Washington D.C. were to make a retroactive back to 100%, we don't need to change anything in our study. The CPA will just take the information that's in the study and apply the percentage.
so if that happens, basically the step down that happened in 2022 and 2023 would pretty much go back to 100%. So even for a lot of people, that's going to help them.
Yeah, the proposal was that it would be retroactive 100% and actually go through December of 2024, but or actually 25. I'm sorry. So again, you can't hang your head on that. We don't know what's going to actually happen, but we're hoping it will. But
Yeah.
keep in mind that regardless, it's going to be beneficial. And just one closing thing here, I've had some clients that'll ask me, "What's the best property, or what's the best type of deal I can get into to take the maximum benefit from cost segregation?" And I said, even though that's what we do, I think you're looking at it incorrectly. I think what you should be looking at are what are the fundamentals of the deal. What am I going to get on cash flow? What am I going to get on appreciation and things of that nature? And then, make sure you take a look at the fundamentals, and then whatever you get on the cost segregation is just going to be cream on the top of it. So take a look at that. Don't look at first just what am I going to get from cost seg, because you might get huge tax benefits, but if it's a lousy deal, what's the point?
Absolutely. Mark, that was definitely a great closing. Thank you so much for the sharing and the knowledge that you provided. There's definitely a lot of wealth of information. We'll be recording for a lot of the people that have registered and not being able to attend today. Appreciate your time. Is there any final thoughts, or in terms of how people would be, what's the best way to reach out for you? Is it cell phone, email? I'm sharing it on the screen here so everybody can see.
Either works. I mean, there's sometimes people will want to have an initial call just so they kind of get an understanding of what are the basics of cost segregation. I'd say the majority of people just go ahead and send me an email, but I'm open to anything. I mean, because my objective is to be of service to the client and whatever they need. So whatever suits them best is fine with me.
Wonderful. Yeah, Mark, thank you so much for your time and all the knowledge. We truly appreciate it. I'm gonna pause the recording.